letting you guys.
We'll pause recording.
Everyone, welcome to this webinar on healthy habits and wealthy results. Quick check, am I audible? If yes, just put it on the chat box. Yes, audible. Thank you. Thank you so much for confirming. So yes, our today's topic is healthy habits and wealthy results. We all know the importance of maintaining good health. It helps us stay fit, protects us from diseases, and lets us enjoy our favorite foods without worrying. When we think of good health, we often focus primarily on physical health. However, there is another equally important aspect, that is financial health. Being financially fit helps us feel secure and gives us peace of mind. If you are physically fit, you can enjoy an extra cookie without worrying about calories. Similarly, if you are financially fit, you can go on that dream vacation or buy your favorite gadget without stressing about the cash outflows. We understand that finance often feels like a world of dry, boring numbers. And that's exactly why we have our expert today, Ms. Shweta Rai. She will draw powerful parallels between principles of physical health and financial health. In this webinar, you will discover that managing your finances does not require you to be a number expert, whether it's financial health or physical health. All it takes is discipline and some basic knowledge. About Shweta, Shweta brings over a decade of experience in financial planning and wealth management. As a senior vice president at IMMPL, she plays a pivotal role in shaping financial strategies and delivering comprehensive wealth solutions. She is a certified financial planner and a certified financial transitionist. Currently, she leads IMMPL's client engagements in Hyderabad, offering personalized, high-impact financial guidance. Shweta, we are delighted to have you as a speaker today. Over to you.
Thank you, Sunny. Thank you so much for that lovely introduction. And to quickly get on with the presentation, I will share my screen, and if you can confirm that it's visible.
Yes,
Is
Shweta,
it
it's
showing up?
visible. Yes.
Great. Thank you so much. Good evening, everyone. Thank you so much for joining us on a Friday evening. Today, yes, we are going to talk about a topic that we tend to not focus on, either find it very complicated, as Sunny rightly mentioned, or just don't find the time, to put it simply. So we'll just identify simple ways or aspects to keep a tab on to be able to manage finances well, and more importantly, feel more confident about our own finances. Staying with the topic, drawing an analogy between a doctor and a financial advisor. If we have to visualize our financial well-being and imagine money to be our body, then a financial advisor works as a doctor. It's as simple as that. While we do vital check-ins at regular intervals, similarly, there are certain areas that work well at a periodic check-in, leading us to know what needs to be done, any course correction to be done within our financial health as well. Again, some financial stress symptoms that we also see, like we do in our health, be it with respect to blood pressure, diabetes, or any other area of health concern. Similarly, there are symptoms that you can keep a watch on to say that if these are in check, my financial life, again, continues to be healthy and worry-free. Since we spoke about the vitals, on the left side, we have certain vitals that we typically talk about when we look at a health point of view. And let's sort of keep our focus on the right side, which are the financial equivalents, largely so. First and foremost is the monthly cash flow. While cash flow, if we have to look at it in the larger scheme of financial management, falls as the heart of money management. If this goes right, everything sort of falls in place. And that's a pivotal starting point in terms of good money management. The other areas that we should keep a tab on is, of course, how's our debt? We'll talk more about this in the subsequent slides, but it's all about our credit management and debt management habits. Asset allocation spread, again, it's all about how are my investments without going too technical. If we have to look at it from a very basic standpoint to say how much of the money is sitting in bank, right? I mean, we know that bank interest don't earn much, yet we do allocate a large portion of our savings idling in the bank account. So how much is that? Is that a higher proportion of the ratio versus what I am putting away towards the investments? And when I say investments, the intent is to build a portfolio of asset classes which holistically are allowing me to beat the inflation number. Else I'm getting into the zone of eroding my money. So that's where asset allocation spread becomes important. Insurance coverage, again, that's the fundamental base to start with a good, healthy financial life. The reason being that's where we mitigate risk. That's the area that needs to be looked at holistically to ensure that the financial well-being are not impacted by certain unplanned eventualities in our life. That's the role of insurance in our financial wellness. And of course, the peace of mind, while the above are sort of taken into account and being managed, the intent is all of this should lead to a peace of mind for me to have a good night's sleep. So, and how do we sort of get this, right? So, to be able to have a good monthly cash flow and all other points that we spoke about, it's largely all about maintaining a consistent money habit life. So what are those? Like we're talking about money habits, but what are the areas that we should look at when we are talking about good money management? First, and of course, budgeting. Like we said, that's the heart, and a good cash flow management leads in and feeds into the other aspects of money management. If I'm not managing my cash flow well, which means I am not generating sufficient surplus to be able to divert it into my other different buckets, be it my emergency coffers or be it my investments that I'm intending to do towards my fulfillment of my goals, or be able to take out the right quantum of money from my cash flow to be able to pay for my risk protection. So as I said, it begins with the cash flow. So budgeting and keeping track. While yes, we talk a lot about thumb rules, where we say that, okay, 50% should go towards my needs, and then subsequently a portion of it towards my want, and so on and so forth. But in reality, it's each to its own, right? So today, if I'm able to save more, which means be it, I am going to do that, knowing very well there is going to be a time where I may not be able to, wherein I might have taken up other responsibilities and commitments, which could be one of which that comes top of my mind is a home loan. When a large part of my surplus income has to be diverted towards a home loan, then I need to plan that better. When I have an opportunity to save better, it's good to always, it's a good habit to save more when you have the opportunity, to be able to allow you to get you the flexibility to be able to manage the cash flows when you aren't able to. Second is, again, emergency fund. Again, a very age-old mindset when we speak from the Indian context as well, save for the rainy day. The idea is to make some sort of corpus available to deal with any sort of unplanned, unthought, not thought through expenses that may just come up in front of us. Now, again, largely we say that emergency corpus needs to be anywhere between 3 to 6 months of our expenses. But going back to the point, it's very personal. If I am into a system or a work life that does not allow me to generate a regular cash flow, probably I may want to maintain a high emergency corpus. Vis-a-vis, if I am not secure about my job, again, a high emergency corpus, and vice versa. So that's the role an emergency corpus plays. I'm going to look at risk protection first before goal-based investing, because I think apart from emergency planning, insurance protection takes precedence. When we talk about insurance protection, it's about protecting our lives. When we talk about protecting our lives, we are largely talking about protecting the economic value of my life. What is it that I bring home economically to make sure there is a cash flow engine running, right? So what is that value that's coming in and which needs to be protected in case I'm not there tomorrow? So how am I protecting my family to make sure the economic value of my being is not compromised? Second is, again, the health insurance, which largely sort of takes care of any hospitalization expenses. Again, unplanned. Do I need to always depend to my emergency? Because in case I don't have an health insurance and I'm very prudent at money management, the first place that I may want to dip into would be my emergency corpus. Would I want to do that when I have an alternate in the form of a health insurance available? May not be. Again, that's something I can take care of through my regular cash flow management, wherein I provide to pay for my regular insurance premiums to take care of any unplanned expenses that may just come up in case of any health concerns. Then, of course, goal-based planning to make sure I am able to invest prudently to be able, again, inflation beating returns, to be able to fund my goals that are going to come up in future. Lastly, I need to look at my regular reviews. So while I do my goal-based planning, I need to monitor my investments. And when I say we need to monitor the investments, don't really mean that we need to check in almost every day, every week. Once a quarter, once in 6 months is a good time frame to just do a quick check-in with a lens to say, is my asset allocation all right? Is my portfolio functioning well in the context of, am I going overweight on any of the asset classes, which is not aligned to my risk profile? So that's the check-in you may want to do in sense if there is a need for any sort of rebalancing to be done. One. Second, is there any goal that's going to come up in near future, planned for, say, in next 6 months to a year, depending on the quantum of money needed? Is there a need to do some sort of profit booking, make sure funds are available in a more safer asset category so that I'm able to withdraw without seeing major fluctuations in my portfolio before I withdraw when the need arises? And estate planning is largely about how am I going to leave the assets or the investments and other economically valuable things that I've created through my life for the next generation. So these are broadly the components that allow us to build good money habits and allow us to get to a state of better financial wellness. Again, having spoken about that, what it is largely about, maintaining a structured plan versus having no plan at all. Recently, one of the major ones, of course, when we look at it from today's context, is a lot about debt. I'm sure all of you would also be reading in papers saying that, the quantum of debt is increasing. So there was a study that was recently done by RBI as well to identify what is the proportion of debt to GDP. and currently it stands at 41%. And if we have to sort of look at in some context, 10 years back in 2015, this number was at 15%. So that's the ratio at which the debt has gone up in the country. Having said that, there are two types of debt, right? One is I take a debt to be able to create an asset for myself, which is an appreciating asset, which typically is a real estate. Now, the other part of debt today that we see a lot is the consumable debt, wherein, buy now, pay later kind of a concept. Now, that's a dangerous one. And that's the proportion that is going up. And again, referencing back to the RBI report, out of the 40% debt that we spoke about, 53 accounts for this portion. So again, that's leads us into the next concept of lifestyle inflation, right? Interestingly, recently we were having a conversation. I was, chatting with one of my colleagues, and we were discussing about lifestyle inflation and how should one view it, right? So again, it's more about knowing what's a need versus what is a want for me, and then allocating my funds accordingly. So the regular check-ins on cash flow definitely makes a lot of difference when you are trying to understand what is that lifestyle inflation that I am dealing with, right? A good way of keeping control of it is pre-committing to investments versus reactive spending. So if I'm able to commit towards my investment first, then automatically I am not going to have excess money sitting in my bank to be directed towards the lifestyle inflation requirements or just my wants. Having said that, the flexibilities that we have today, that we just spoke about a buy now, pay later concept, now that needs to be monitored well to be able to manage this part. Some red flags, in case, the life is becoming more paycheck to paycheck, then that's a big red flag. If I'm not able to have any sort of surplus in my bank account once I am towards the end of the month, that's one of the red flags that should be an indicator for me to just go back, review my expenses, and see what needs to be cut out. Or is there any opportunity or scope to revisit my expenses? And third is, of course, conscious upgrade. Yes, all of us would want to upgrade. Again, 70% of iPhones bought today are on buy now, pay later concept. So all the upgrades needs to be made very consciously, keeping in view the cash flow, what's going towards your investments. Is that getting compromised? If it is, then probably a time to sort of pause, revisit, rethink as to how you would want to structure the piece. Probably you may just want to postpone it by, some time before the cash flow sorts of eases out and it allows you to make that purchase versus taking on a loan to make that upgrade. Now, what is the role of a financial planner, right? And we do talk about a lot of do-it-yourself tools. How does a financial planner bring value in terms of when you have something like a do-it-yourself option already available? One, financial planner, I think a financial advisor allows you to see things objectively. While DIY is in front of you, it's the thinking that you need to do, bring in the self-discipline, and be able to objectively view things in the context of what needs to be done now and what needs to be done later, to be able to just have that conversation. Obviously, the financial advisor is not going to provide you with a judgment to say that this is ought to be done or not, but definitely a financial advisor is going to bring in that perspective to show you the different aspects of particular decisions that need to be taken. And second, and another crucial part of it is, a lot of it, the investments that we do, we are very emotional about it. So again, objectivity is another key part, like we spoke, in decisions with respect to that as well. So it's more like, while, again, if we have to sort of go back to the analogy that we started off with, what is it that a doctor brings to the table with respect to my personal health? It's when I know everything that's available online, it's very similar what a financial advisor would bring to the table, again, when everything is available online. So again, when we talk about, we briefly did speak about risk protection. So if we sort of have to speak further on the topic, life insurance, right? To start off with, first and foremost, life insurance is never about me as an individual. Life insurance is always about my family and the dependents who are relying on me for adding that economic value, right? If I have dependents in my life, I need a life insurance policy immediately, right? If you're somebody who just started earning and there are no dependents, yet I would suggest it would be a good time to purchase insurance. The reason being, again, going back to the numbers part of it, it becomes slightly more, less expensive because you purchased and locked in your premium price much earlier in your life versus having to wait till the time when you see those dependency or liabilities come your way when you ought to take insurance, right? So that way, life insurance work better because these policies are taken for a 30-year duration. That's the term available. And if you're able to lock in at a lesser price than for a larger sum insured, it works well. Next, health insurance. Again, it's basically to make sure that there are no drains or strain on my portfolio, which are being built with an intention to fund a particular goal of mine. Now, in case I have an expense which was totally unplanned, like a hospital expense, I have completely derailed from the track of my investments to be able to achieve my goals. Now, I'm looking at a scenario where I probably may just have to postpone certain goals in my life just because I hadn't planned for an eventuality like an hospitalization that may occur. So, which is where health insurance becomes very, very important. We've seen a time period like COVID. I mean, who would have thought of it, right? And imagine more than one, and we've seen where more than one family member being hospitalized. So these policies definitely are become very handy in such scenarios. Critical illness, disability covers. This again, a very, very important cover considering the lifestyle that we lead today and the number of instances that we come to know of where some colleague, some friend, somebody whom we know personally or indirectly is going through some sort of a critical illness. I mean, we do hear of such cases much more often today than in the past. And what critical illness policy does is, while health insurance takes care of hospitalization expenses, in such situations, a critical illness policy pays out a lump sum. So normally, in case I am recovering from a critical illness, I may not return to active work life immediately. I may have gone on a sabbatical on health grounds, but I need a cash flow to run my day-to-day expenses. And that's where critical illness policy becomes handy. So again, it's an important piece in the whole puzzle of ensuring good risk protection for our family and ourselves. So like we look at, a portfolio of investments where we have different asset classes and we say each has its role and purpose, right? So for example, if we talk about equities, we invest into equities with an intent to see growth in the portfolio, whereas debt is largely about maintaining that protection in the portfolio and building that stability in the portfolio. Of course, the ratios would vary, but the job of both are extremely critical to have a robust and a healthy portfolio created. Similarly, when we look at insurances, it's very important to have all these insurances in the portfolio of risk management. And last is a checklist, so to say that, what should you know and have in place is very, very important, so that you've called out to say that what's available, what's not done, and plan for it to say that, okay, if it's not done this month, am I planning to do it next month? So a checklist always helps so that we don't lose sight on the steps that have already been taken towards ensuring risk protections are in place versus something that gets postponed. And typically it's such a thing that sometimes it just goes off the radar and gets missed out. So focus on risk protection and treat it like a foundation towards building a healthy financial life. Coming to the next point of financial life transitions and financial wellness, right? I mean, we all know as individuals, typically we all go through at least 5 to 6 life transitions in our lifetime. Some may be big, some may not be, some may be event-based, some may be non-event-based. But the point is we do go through transitions wherein life changes from a normal to a new normal. Now, when that transition is happening, there is a lot of uncertainty in our minds. We, as individuals, we go through a transition phase, like we call it in the course, where we're trying to deal with the struggle in our mind in terms of what we are going through. If it is not a happy transition, wherein we could have a narrow focus, we could experience fatigue. And in such scenarios, having to take critical financial decisions becomes the key. How do you navigate the situation? What do we do? And that's where a qualified financial advisor helps you keep you in a safe place and be able to tell you that it's all right not to take a decision today, or it's extremely important that one part of the decision is taken, but the remaining could be postponed. You need that thinking partner when you're talking about your finances in such scenarios as well. Okay, if we can take a pause here and if you have a phone, can use your phone to quickly scan this and put up your whatever comes to your mind first when we talk about the biggest money worry today. And I'll try to put the link on chat as well.
Yeah, so everyone pick your phone and just put this on your scanner. If at all you are not able to open the scanner, then we are also putting the link on the chat. Click on it and just mention the one word that comes to your mind when it's about money worry. I request everyone, instead of putting it on the chat, if you can just put it on the application or on the link on the site that this link will lead to, so that we will have a better collective picture.
So I've put up the link and I will stop sharing this screen so that we view the results that all of us are putting up as well. Overspending, yes. Scams, yes. So I think inflation is turning out to be the winner there, right in the center. Medical emergency, yes. We spoke about health insurance as one way to at least protect to one part of it that can be covered through wherever the expenses are being met through hospitalization. And of course, today when we talk about health insurance, one thing to keep in mind is health cover is static. For example, if I have taken a health insurance of say 20 lakh, 50 lakh, 80 lakh once a year, that's static. While my health inflation is constantly increasing, and that's increasing at a rate of 12%, which is more than double the CPI. So recommend if you're looking at getting your health insurance done, please look at a higher value. Typically, a 1 CR is something good and comfortable to start off with, and then at regular intervals, every couple of years, look at increasing your coverage value. Great, thank you so much. And I hope a lot of this part we did covered in terms of how do we manage debt. Okay, one point on debt management, while we did speak about that should not go high, but how do we have the check-ins, right? Normally, as a good practice, we say that combined debt should not go beyond 35%, right? If in terms of the EMI of the monthly take-home salary. The reason being, if that's in that range of 30 to 35%, it allows you to ensure your cash flow is available to take care of other needs. One, the regular requirements in terms of the needs that needs to be met. One part of it can still go to your wants because you have that surplus available, and yet still be able to ensure some money is going towards your regular savings and investments, which are more linked to your long-term goals. So that's on debt management. Retirement, yes, another big worry of outliving our funds. And interestingly, especially with youngsters, when we talk about retirement, right, we always say that there is a loan for everything else, but there is no loan to fund retirement. And normally it's always that this particular goal, if inadvertently takes the back seat, which should not be the case. So, and again, when you try to have a conversation, the difficult part is also being able to visualize a period of retirement, which for a youngster is really far away. And to visualize something that's so much in future, it gets a little difficult. So typically gets on the back burner, but that shouldn't be the case. Always remember, for everything else today, we have an option to take a loan, but for retirement, we do not. So retirement planning should start with the first paycheck. One part of it, that's again a good money habit to say that one part of the paycheck is being diverted towards ensuring the retirement goal is met. Controlling expenses, again, regular check-ins are good to be able to evaluate, take that judgment call, and just see what's the trade-off that is happening of spending on certain things that may or may not be critical today versus something that's important going forward, something that's being spent towards an instant gratification versus something that's going to provide a meaningful gratification in future, like, funding a very, very important goal. So I think when you are doing your regular check-ins, be it with the cash flow, be it with investments, I think these check-ins are good to understand what's the trade-off. even with investments, it's good to say that, a particular investment is going to give me a kick in terms of getting the high returns. But again, what is the risk attached to it? What would happen in case you lose that money? If that's your play money, great, go ahead, bet on that investment. But if it is not, then be watchful. I mean, instead of going and putting in money there. So a good way is just to sort of check in a manner to say, what if it works out and what if it doesn't work out? So that typically gives a good picture on that. And I'm sorry, I think I missed sharing the screen. So here are the responses that we got. Sorry, I've been talking from the slide and I didn't realize that I didn't share my screen. So here are the responses that all of us have spoken about. And I've largely picked pointers from here when we spoke about debt, savings, not overspending. So largely try to cover most of the pointers here. Okay, thank you so much for these responses. And as we move ahead, I'm going back to our slide deck. It's visible, right, Sunny?
Yes, Shweta, it's visible. Yeah.
Yeah. So again, coming back from, so the intent is, build good financial habits. So in a way to be able to achieve the financial wellness. And once we are getting into the financial wellness zone, wherein we are able to track cash flows, keep tab on investments, generally being aware of our financial life, it allows us and paves the way into financial well-being. And when we talk about financial well-being, it's more about feeling in control and feeling more confident about our own money. So eventually that's the end goal to be met through these good money habits. Again, I think we've spoken about this, but a quick step-by-step approach. First is definitely budget check-ins. Are we on track, not on track? If anything needs to be changed. Emergency fund tracker. If there is a need to refill, increase emergency fund in case you feel, the current life situations warrants for that, then increase your emergency coffers. Do your insurance reviews regularly. For example, if you're acquiring a home loan, then definitely it means getting added cover. If there is a transition in life where you have a child, which means there is added responsibility in terms of their education. So in case anything were to happen, you wouldn't want a critical goal like child education to be at a compromise. So again, regular check-ins on insurance review is important. And health insurance, as we said, inflation is going up year on year, but our coverage is not. So never sort of buy insurance and leave it, review it to see if there is a need to enhance your health insurance. Portfolio rebalancing, again, look at overall asset allocation. Is that aligned to the risk profile? Is it aligned to your goal needs? And take that call. Again, while we spoke about, the budget check-ins, so this more on, good money habits contextually, that allows you to pave the way into that next level to say that, okay, goal mapping, wherein we are looking at cash flows and are being able to map the surplus money to our goals, track investments, ensure wills and nomination summaries in place, emergency contact sheets are updated all the time, documents are in place and the family is aware about it. So another very important part is, while we feel that there is a repository and there is a method to the way which we track our finances and maintain the logs and critical information pertaining to it, it's very important family is also aware about it. Because eventually, again, if anything were to happen, somebody in the family ought to know. So make sure that at least one another member in the family is aware of all the uh, critical financial information about the family. Um, Last one, call to action. So while we've spoken, in case you want to talk further with any of the financial experts, happy to do so. You can always use the QR, block a 30-minute time slot, and our teams would be very, very happy to speak with you and answer any questions that you may have. So I do see a lot of new names also on the participants. So please avail the benefit. And if you would like to talk to any expert, please do so. Yeah, that's about it from me. Open to Q&A. Over to you, Sunny.
Shweta, before Q&A, we will share one link. It's a feedback link. So I request all the participants to just take out 5 minutes and fill up the feedback link. It's a very short link, won't take much time, but it will help us to bring many more such insightful sessions and conversations with all of you. So Akansha has already shared the link. I request you all to take some time. It won't take much time. Take out 5 minutes and just give us the feedback. Thank you. Shweta, after 5 minutes, once all the feedback is done, we can
Sure.
get with the Q&A.
Sure.
In the meantime, Shweta, if you can just keep the slide of QR code open on
Yeah.
in case if anyone wants to book the
Yes.
consultation.
Yes. Here it is.
Yeah. So in case if anyone of you would like to book a financial checkup session with us, here's a QR code, click on it and just give your confirmation and then our team will reach out to you. Once you are done with the feedback, just put a done in on the chat and accordingly we'll come to know and then we'll take the Q&A. Okay, Shweta. So in the meantime, while people are giving the feedback, we can start with the Q&A that has already come. So
Sure.
one question was on the insurance review. So the question is that as far as I am aware, there is no option for enhancing existing term plan with any insurer. Always we need to switch the company and enhance based off on the age of that period. So is there any way where we can, continue with our existing premium benefits and enhance the sum insured cover?
This is term or health
Term.
term. Okay,
Yeah.
so largely the way life insurance works is when we take the policy, right? We are committing to a contract. There is an offer made, and we are committing to a contract to say that I am acquiring a 1 crore insurance coverage towards which I am going to pay, say, a 15,000 premium year on year for the next 30 years, right? So that's a one-time contract that we make, and it's binding for the next 30 years for both parties. So that's the reason you will not be able to enhance the coverage on the same contract. And we need to purchase a new policy to be able to increase our life insurance coverage. Now, it also works well in situations, for example, if you are young, just started off, right? In your early 20s, if you have to sort of pick an example. And we say that, a life insurance coverage is available for a period of 30 years. Now, by the time for the coverage in case I've taken in my 20s, that is ready to lapse and complete by the time I'm in my 50s, right? And typically 50s is the age when the maximum responsibilities and need for a life cover also becomes important. Now, here it is. So, which is where we say that we need to start acquiring life insurance coverage in on regular intervals. Like, for example, I take one in my 20s, make sure that I have entered into and taken some protection to take care of any of my immediate responsibilities that may come in near future. But at the same time, when there is a shift, for example, I have acquired a home loan, I starting a family, which is a time to revisit, evaluate my insurance need, and take another policy at that time. So this could be possibly in your 30s. Now you take another 1 CR in your 30s. Now you have a 2 CR coverage during the period when you have the maximum responsibilities, and this is available to you till the time you turn 60. So that's how you need to plan your life insurances, where you do your regular check-ins. And similarly, if you've met your goal, you've created your asset, and there is no need to cover a policy, continue a particular life insurance policy, you could drop it, right? And that's the beauty of a pure term cover. You can take it, and when you feel there is no need, you can actually drop it, right? So largely look at it like a glass of water, which today is being filled by the way of investments and savings that we do. And obviously, it's going to take time to completely get filled up. But at the same time, there is a constant need to ensure my glass is always full, because that's how much I need to make sure all my goals are met. Now, it's always the gap is what the insurance policy is supposed to cover. If my water is filling up, then my gap is reducing. I may not need that insurance cover all the time. So reviews are done with two aspects, right? One, how much of a cover I need more versus do I need so much cover? So it's always good to sort of break it down and not have all your cover within one policy as well. So that brings in your diversification on your insurance. And two, it brings in the flexibility as well to choose in case you want to drop any policy.
Sure. Thanks, Shweta. So what I take is like it's like a balance between both insurance and investment, like a seesaw. So we have to make that balance, and as one gets filled up, we have to let go the other one.
Review. I mean, not see, there are multiple ways of looking at policy,
Hmm.
right? I mean, I know of instances where we said that I know my investments are now ready to fund all my goals. I'm financially free. I don't need insurance, right? For example, I'm at that stage, right? But I may choose to continue my insurance policy because that's another way of leaving behind something for the family, some add-on, right? Apart from what I've created. So it could work as an estate plan. So then now term policy is one type of policy that we are looking at today. Similarly, there are multiple other ways in which we could look at insurance. There are other products available. It's always about the intent. When we are talking in the context of protection, we are talking about a pure term cover, right? If the intent is something different, then obviously there are other policies that we can look at.
Okay. Next question is how frequent, it's about the portfolio. So how frequently should we review our portfolio?
When you're reviewing your portfolio, it could be anywhere with, you could do a check-in once a quarter or once in 6 months, more with the intention of just viewing your asset allocation, making sure the schemes are fine. Because of course, I'm talking more, assuming the portfolio is largely to start off with is with mutual funds. So which means you're not going to trade, right? The intent is to invest for a long period. And with that intention, the portfolio has been created. So the check-ins would largely be in the context of one, rebalancing, and two, in the context, if I have any major milestones coming up in near future, then I may want to do some rejig to say that, okay, now I need to book some profits, bringing into a more safer asset category so that it's available to me when I need to withdraw.
Okay. Okay. And the follow-on question to this was, if let's say a person or an investor has a financial planner, then to what extent should the portfolio be tracked by a person?
I think tracking of the portfolio should largely be done along with your financial planner and your advisor, because as an advisor, they would be anyways tracking your portfolio and monitoring it. It's always good to have that conversation, a regular check-in with your advisor, just to understand how the portfolio is doing and where you stand.
Okay. Okay. Thanks for asking this question, and thanks, Shweta. The next is, how do we track inflation and align our savings? So very important.
Yeah. So again goes back to the point on tracking the budget, right? Because honestly, when we look at inflation as well, while we have a CPI where we say that, okay, my food is going to cost me so much and my living expenses are going to cost me so much, the other part of it is also about the kind of lifestyle I lead. How much do I need to spend on petrol? Do I use public transport, right? It's largely also about the lifestyle I lead, how important vacation is for me, right? Uh, is that more of a lifestyle choice or more of a need? Now, so these are the classifications that I need to draw on my personal budget to say that these are my needs and these are my wants, and track it accordingly.
Sure. And is there a simple way to track any expenses, like a simple spreadsheet or any applications where these expenses can now be tracked? Anything that can be shared? That's the question.
Excel, yes. I mean, that's an immediate sort of an easy way to sort of track and tool to sort of latch onto. But I'm sure there are apps as well available. But if you are comfortable to sort of do that, great. Otherwise, Excel is good. I personally prefer Excel. It allows me to spend some time with the monthly check-in to say that, okay, here are the expenses, here's what's coming in, what's going out, all of it.
The next is on the company health insurance. So my company is offering health insurance to my mother. This can be continued even after exiting the company with an appropriate premium. Should I still buy an insurance uh, outside the company or the separate policy for?
You should. So there are multiple reasons for that, right? One is absolute fantastic benefit when families cover through the corporate cover. So no two thoughts on that. Second is whether you should have a personal cover. Again, a yes. The reason being, one, we may choose to switch jobs, right? Today I am with the company, tomorrow I may not be with the company, and the new employer don't know whether they are going to provide a family cover or is it going to be individual cover. So these are the parameters that you need to keep in mind, but definitely insurance cover is important for yourself. Uh, for mothers here, I am sort of assuming and that probably, slightly older, probably above 50. In that situation, again, things to check is, are there any lifestyle situations in terms of diabetes or BP? Good to sort of take in earlier. May come with a slightly, so today we have specific policies that allow coverage from day one in such situations as well. So good to sort of take a cover, but complement that with your corporate cover so that at no time you or your family is uninsured. So that's a bigger risk.
Sure. So at any time the insurance should be there.
Yes.
Any. Yeah.
Yeah.
Yeah. And going back to the first question, where the number of life insurance policies that you told that, as we move from one zone to different zone, we should review our life insurance part and then we should evaluate whether we need additional one. Is there any limit on the number of term policies that a person can hold as per the law?
It's
Generally.
based on the income, Sunny. So the eligibility is based on my income, and that's how the coverage is decided. So at a policy level, they wouldn't be, but at my overall coverage level, that would be checked.
Okay. Okay. Okay, so guys, please feel free to drop your question in the Q&A box. We still have 5 more minutes to answer uh, whatever related to this session, your personal finance. Please feel free to drop the question. And Shweta, in the meantime, thank you so much for taking the Q&As. We'll wait for 5 more minutes for people, in case if they have any questions to ask for.
Sure. I see one more question, Sunny. How much equity percentage is recommended during the retirement phase? Right. Again, to answer that question, the first one, two check-in points, I would say. One is what is my monthly requirement, right? Because when we talk about equity allocation, we need to be cognizant of the fact that whatever portion of the money is getting into the equity bucket is more for the long term. And having said that, a retirement portfolio too should have a component of equity. With this in perspective, for example, if I'm able to foresee that I don't need a portion of my corpus for like next 10 years at least, or 7 years at least, then you could look at moving that portion of the corpus into more equity-based investments, right? Something that you need in terms of cash flow planning to say that, okay, how am I going to fund my expenses for next 1 or 2 years, then that needs to be put in a more safer bucket. So that's how you need to sort of look at your overall retirement portfolio allocations, centered around your requirement of one, cash flows, how much do I need, and then sort of build it around your own risk profile to say what's comfortable to you, and then take it forward.
Thanks, Shweta. So we'll wait for a minute more, guys. If you have any questions, please put it in the Q&A box. In the meantime, if you have something that you want to discuss about your finances, then please use the scanner, scan through the QR code available flashing on your screen, and just book the session with us. And someone from our team will get back to you, and then you can have the quick 20 minutes discussion call about your finances. All right, Shweta. So no more questions. Thank you so much for taking the session, and I'm sure that there must be some food for all of us who are attending this, be it insurance, be it portfolio, be it anything about, simply about managing your cash flows, because it looks simple but it's very important, and all it needs is discipline as the first stone to maintain it.
Yeah.
So thank you so much, and to all the participants, thank you so much for attending this call and being with us, and also sharing your Q&As. Thank you for joining in, and we will meet you in the next session with a new topic.
Thank you. Thank you so much, Sunny. Thank you, everyone. Bye-bye.
Thank you. Bye.